two things to watch that are keeping things together. One is consumer confidence that Terry had on the screen, and she showed how high it is. If you looked at that screen chart with the jaundiced eye, you might have noticed that it's often at this type of level 6 months before a recession. It starts tanking before the recession comes. That hasn't happened yet. However, another indicator is to notice how consumers are thinking about the future and compare it to how they think about today. Right now, consumers are thinking today is pretty good.
Jeff is concerned about, I think primarily, wouldn't it be the Fed? Because damned if they do and damned if they don't. Is that what I heard? Jeffrey Gundlach, famed money manager and CEO of DoubleLine Capital, with $140 billion in assets under management. Since he started DoubleLine more than a decade ago, Jeff's been given every award. The firm's total return bond fund, a bond fund, is way out ahead of its benchmark, and its Cape Schiller equity fund also. I'm not going to give you all the details, but let me just say that last year, as you saw in the opening video, Jeff was concerned about the economy and a recession. He was the one that early on, 4 or 5 years ago, predicted Trump would win. He was hedging his bets on that last year. Good move, Jeff. And he worried that inflation and the Fed's ability to keep rates down would resume. I can't wait to hear what he thinks about that. Last year, when we asked Jeff how to invest $100,000, he suggested emerging markets, which have been on fire this year, and gold, which had its best year, although I know mid-year when I asked him, he had sort of gotten out of it when gold was $2,000 an ounce. And his DoubleLine Schiller Cape Fund was an equity fund with the most conservative investment in his portfolio, and it too performed very well, beating its benchmark. And he said the Dow would end the year at 28,200. So, Jeff, we're ready to turn to your forecast. I'm keeping notes because I want you back next year to defend it or brag about it. Jeff Gundlach.
Are you interested in forecasts on those metrics that you had the audience pull on?
Jeff, I keep a chart here, and I have last year's chart. Here's last year's chart right here. So I really write down everything you say. You want to give me metrics?
All right. I think that Bitcoin, I was very bullish on Bitcoin last year, but I've tempered that bullishness. Actually, I turned neutral on Bitcoin at 23,000. It seemed very high at the time. Of course, it went to 40,000 like a week later. But when you get that type of volatility, my experience shows that you're quite near at least a local top. And since Bitcoin is so volatile, I think I'm just going to take a round number and say it's going to be cut in half, down to 20,000, roughly. I think that the U.S. stock market is extremely overvalued, but it's resting upon tremendous stimulus and promises of zero interest rates from the Fed. But still, I think that there's a lot of concern. We talked about consumer confidence last year. You'll notice that consumer confidence has not improved from the depths of the lockdown. I also think we're still in a recession, in essence, because we haven't had the job growth go back to anything close to the peak pre-pandemic. I have a funny way of looking at a lot of things, and one of the funny things I look at is recessions. I don't say that if you get 2 positive quarters, you're out of a recession. I say you got to take out the past peak. So we're still in recession. And I think the Dow Jones Industrials, weirdly, I don't remember my forecast from last year, but I have exactly the same forecast almost, 28,000 at the end of this year. I think the NASDAQ has given up the ghost in terms of leadership. I call them the generals, the Super Six plus Microsoft, you know, the Googles and Amazons and Facebooks and Twitter and all that plus Microsoft. They've stopped their leadership on the upside and are in fact now lagging. And that's usually a bad sign. When the generals that led the charge are leaving the battlefield, it often means there's a rotation. So I'm going to say the NASDAQ goes down to a nice round number of 10,000. I think the 10-year, absent the Fed coming in and rescuing the long end of the market, would go much higher in yield, but the Fed has committed to yield curve control. The issuance of bonds is extremely high, and there is no buying by foreigners. There's no buying by domestic interests. Buying is all the Fed, basically. And the Fed would need to buy another like 1.9 trillion more bonds than they're committed to with their 120 billion a month of QE that they've promised. So the 10-year yield will go up, I think, but not as high as it should, because the Fed will probably come in and try to maintain it at a lower level than the market would price it. But I still think it goes to 1.95 near the end of the year. Unemployment, unfortunately, I think goes up. We're starting to see that already. Terrible claims number, terrible employment number. And I've just started to hear some corroboration of an idea that I'm afraid is going to gain traction in the consensus narrative, that unemployment is going to start climbing the economic ladder. I think once we get to 1 year on lockdown, CEOs have to really start asking themselves, when am I going to start restructuring my business and stop pretending that this is just temporary? And that means significant restructurings. And I just got a message today, this very morning, from a big bank that had promised no layoffs during lockdown, and they announced that they just can't keep that up anymore. So they weren't massive layoffs. It's a big bank. They're laying off, like less than 1,000, several hundred people. I think that's going to continue, unfortunately. So I think unemployment is going to continue to go up from the levels that we see right now.
You covered the whole waterfront. So let me ask you to go ahead and you've been ahead of the curve on a lot of this stuff. We're going to have a stimulus, maybe another stimulus. Give us your view of how the economy looks, just the narrative view. Thank you for hitting all my high points. What's your narrative view of how the economy looks this year, given those numbers you gave us?
Well, the economy is being propelled exclusively by Andrew Yang's giveaway program, essentially. It's funny how a year ago you mentioned we were talking about that, and it actually got implemented without Andrew Yang, with the $2,000 to everybody, and they're talking about that again. So the economy is being propelled exclusively by borrowing. I mean, 20% is the real deficit as a percentage of GDP. So obviously, if we hadn't expanded the deficit by 15 percentage points, we'd have a massive negative economy. The biggest issue that the market has to deal with is not just a forecast of inflation, but the reality that inflation is going to move higher in the next 5 months with almost metaphysical certitude, because the base effect of the initial lockdown is rolling off in a few months. And so we have a simple inflation model at DoubleLine, and it suggests that inflation is going to go close to 3% in the number that's reported for May in June. And I saw a fairly highly respected economist yesterday put out a forecast of a 4% inflation rate by mid-year. The Fed has been preparing the market for these ugly inflation prints by getting in front of it and saying, we're not worried about inflation above 2.5%. But concerning to the market will be comments by Fed governors like the number 2 guy at the Fed, Charlie Evans, who actually had the gall to say relative to inflation, we want to get it higher and we're in it to win it, which is a pretty interesting phrase compared to, 30 years ago, 40 years ago, when we were in it to get rid of inflation. But the Fed wants inflation. They're going to tolerate this 3% and maybe even higher prints in mid-year. But what will the bond market think of that if the year isn't at a higher level? So I think the yield has to go up. And that inflation aspect, I think, is going to start getting a lot of attention as we move just a few months.
Okay, let me just round you out so we have that whole economic picture and the investment picture too, Jeff. If inflation goes up, the question is, as you pointed out, how much control does the Fed have over interest rates, especially if they're cheerleading inflation? And last year you made a key point. If you're going to be in bonds, you got to be in the triple B bonds, the worst ones, because who knew the Fed would bail them out the way they did? So if you talk about higher interest rates, higher inflation, a lower dollar, more borrowing, more stimulus, tell me about the bond market. You're the bond king and the modern bond king, and versus the stock market. And I'll ask you later where you want to be when you create a portfolio for $100,000. But just give us your perspective. A lot of people are saying, oh, I have to lock up some 3% bonds because, I get nothing in the bank. What's the risk?
Well, if you could find some 3% bonds, that would be nice. The triple B bond today on an index basis yields 2.15 to no defaults. And so that's not very attractive. Bonds are very overvalued versus inflation right now. They're very overvalued versus the coming supply. But stocks are very overvalued too. They're in the top 1% of valuation on many, many metrics going back decades in history. But basically, based upon this yield suppression by the Fed, stocks are actually cheaper than bonds right now, in my opinion. Treasury bonds in particular. Having said that, I still think you're supposed to own some 30-year Treasury bonds as a ballast, because we have plenty of evidence, if the economy really gets ugly, that bond yields could fall down to, well, 0.5% or something. And the 30-year Treasury is more than 100 basis points higher than that. So you do have some benefit there. But I think you're better off in the bond market now in bank loans, which are floating rate, and they can't float lower because the Fed has promised not to take rates negative. And so you get a yield that is at least in the 2s, and if the riskier ones, you do get about 3. And if inflation comes and for some reason there is a rise in rates, which nobody expects because of the Fed's promises this year, but if that happens, you've got protection with a floating coupon. So that's, and you can buy bank loans like that through ETFs, and so that's a way to get exposure to bank loans. I think that's one way to play it.
Okay, Jeffrey, God, you've nailed it so often. How do you play the $100,000 game this year?
I'll get to that in a second. First of all, I want to agree with James on this volatility concept. That's a theme that I've been on since July, August of 2017, when the narrative shifted to this is a structural shift and we're never going to get the VIX over 15 again. And of course, we haven't seen anything close to 15 in quite some time. And I think what we've seen is ever rising spikes in the VIX ever since that low, exactly that summer of 2017. So I like that play. For my $100,000, I am very bearish on the dollar long term. Short term, I'm not that bearish, but I think the dollar goes lower with all of this debt and deficits. The correlation is really convincing. And so I like emerging markets still, but this time I'm going to buy INDA ETF. And I like the industrial metals play Dr. Bob talked about. Copper's fine with me on that. I go exactly with the same ticker that he used, 25%. And the other 25% is in something that I think you're probably going to lose money in. So it sounds like a weird thing to be recommending, but it's a combination portfolio. So it's a ballast, and that's 25% long-term Treasury bonds, even though I think they're going down. I think with my other 75%, it's a risk mitigator.